On December 29th, 1989, the Nikkei closed at 38,915.87. It did not close above that number for 34 years. In between, 2 lost decades, 3 Bank of Japan governors, the invention of quantitative easing, 15 years of deflation, and a government debt-to-GDP ratio that climbed from 67% to 263. At peak, the land under the Tokyo Imperial Palace was appraised higher than all of California. This is what the biggest asset bubble in modern G7 history looks like, drawn end to end. The bubble had a beginning. On September 22, 1985, finance ministers and central bankers from the United States, Japan, West Germany, France, and the United Kingdom met at the Plaza Hotel in New York and agreed to coordinated intervention to weaken the dollar. At the meeting, the yen traded at 240 per dollar. By early 1988, it traded at 120, a 100% yen appreciation in 2.5 years. The yen appreciation hit Japanese exports. To offset it, the Bank of Japan cut the official discount rate aggressively from 5% in January 1986 to 2.5% by February 87. The 2.5% rate then held for 27 months. By the time Plaza-era easing met Japan's growth dynamics, the Nikkei had moved from 12,598 at the time of the agreement to 38,915 at end of 1989, 3.1 times higher in 4 years and 3 months. The valuation math sat on a structural amplifier. Japanese corporate ownership in the 80s was dominated by Keiretsu, interlocking cross-shareholdings among banks, manufacturers, trading companies, and insurers. By the mid-80s, roughly 40 to 50% of Tokyo Stock Exchange shares were held by other corporations, not by individuals. The same yen of earnings appeared in multiple companies' books. Reported price-to-earnings ratios were inflated by the architecture itself. 1989 was a panic of valuation math, as much as it was a panic of leverage. On December 17th, 1989, 12 days before the Nikkei's all-time high close, Yasushi Mieno, became the 26th governor of the Bank of Japan. His mission statement, reconstructed across Bank of Japan biographies and academic sources, was 4 words long: "We must burst the bubble." The Mieno tightening cycle had already started under his predecessor. 5 rate hikes ran from May 1989 through August 1990. The third, December 25, 1989, raised the official discount rate from 3 3/4 to 4 1/4%, 4 days before the Nikkei peaked. On December 29th, the index closed at 38,915.87. The intraday high, 38,957.44, would not be exceeded for 34 years. The valuation behind the close was extreme even by bubble standards. Trailing earnings multiples on the Nikkei sat at about 60 to 70 times, against roughly 15 for the S&P 500 in the same year. By 1990, the total value of all Japanese property was estimated near $20 trillion, about 5 times the total value of all American property. Despite Japan being roughly 1/25 the physical land area of the United States. The Nikkei opened 1990 at 38,712. It began declining almost immediately. By the end of September 1990, the index had fallen below 21,000, a 46% drop in 9 months. After a brief stabilization in 1991, the index resumed declining and bottomed near 15,000 in mid-1992, by then about 61% below the December 1989 peak. Land prices peaked roughly a year after equities. The urban land price index for the 6 largest Japanese cities reached its all-time high in September 1990, about 4 times the level of September 1985. Tokyo commercial land sat at 168% above the 85 baseline. From the peak, Tokyo commercial land fell about 25% in 1991 and 1992. By 2001, the cumulative decline was 54%. The mechanism that had inflated the bubble worked in reverse on the way down. Japanese banks had accepted land as collateral at loan-to-value ratios of 70 to 80% and remarked appraised values upward each cycle. As land prices fell, existing loans lost their collateral cushion, bank capital fell with both loan losses and direct equity portfolio markdowns, and credit contracted. The banking system stress took 7 years to fully crystallize. Between November 1997 and October 1998, 8 years and 10 months after the Nikkei peak, 4 major Japanese financial firms failed. Sanyo Securities collapsed on November 3, 1997. Hokkaido Takushoku Bank, Hokkaido Takushoku, the 11th largest commercial bank in Japan, failed 2 weeks later. Yamaichi Securities, Yamaichi, one of the country's big 4 brokerages, went under on November 24th. And Long-Term Credit Bank of Japan was nationalized on October 23, 1998. The bubble peaked in 1 day. The banking system took 8 years to catch up. Quick pause. This episode is sponsored by a private community I run. It's where the YouTube version of these case studies extends into multi-month forensics, deep dive analyses on investing, behavioral finance, and the historical mechanics of every bubble we cover. If 34 years of lost decades made you wonder what the math actually looks like, that's the kind of work the Insight is built for. Link is in the description below. Now, back to the aftermath. The lost decade wasn't a metaphor. Real GDP growth in Japan averaged about 1% a year through the 1990s, 1/4 of the 4% average of the 1980s. Nominal GDP in 2001 was approximately the same level as in 1995, just 6 years of zero nominal growth. The GDP deflator began a near continuous decline in 1995. Core CPI deflation crystallized by 1998. Japan's deflation lasted roughly 15 years, with an average inflation rate of negative 0.3%. The Bank of Japan went from a 6% policy rate in August 1990 to 0.5% by September 1995. In February 1999, the BOJ introduced the zero interest rate policy. In March 2001, 21 years before the Federal Reserve did the same, the Bank of Japan introduced quantitative easing. In January 2016, the policy rate went negative. In March 2024, the BOJ raised rates for the first time in 17 years. The fiscal counterpart was the buildup of government debt. Japanese general government debt to GDP rose from 67% in 1990 to 263% by 2024, the highest ratio in the developed world. That ratio is the structural legacy of the post-bubble policy mix. There's a pattern. In March 2000, the NASDAQ composite peaked at 5,048.62. 30 months later, in October 2002, it closed at 1,139.9, a 77% drawdown. The NASDAQ took about 15 years to make a new high. In 2006, the Case-Shiller National Home Price Index peaked at 198. By 2012, it had fallen to 114, 42% below peak. Recovery to a new high took until 2018. The structural shape is the same across all 4 episodes. loose monetary policy following an exogenous shock, asset class concentration, valuation expansion outrunning earnings, central bank tightening, a multi-year unwinding. What makes Japan 89 different is duration. 19.2 years to the final trough, 34 years to the recovery close. Nothing else in the modern record comes close. 34 years, 1 month, and 24 days after the December 29th close, the Nikkei finally closed above its 1989 record, February 22nd, 2024, 39,098.68. 10 days later, on March 4th, the index crossed 40,000 for the first time in its history. The bubble of 1989 produced 34 years of data. We don't predict what comes next. We document what already happened. Every market crash has a pattern. Here it is.